Good morning, everyone, and welcome to the Hill&Smith 2023 interim results presentation. I'll start by covering the key highlights before passing over to Hannah. This has been a record performance for the group, with 20% organic constant currency profit growth, 43% profit growth on a reported basis. The key driver has been a strong performance in our US businesses, giving rise to a 240 basis point uplift in operating margins. The integration of our 4 recent acquisitions has progressed well, and each business is performing in line or ahead of expectations, supported by strong margin expansion. We have a good M&A pipeline going into the second half of the year. Cash conversion has been strong at 87%, and we are declaring a 15% increase in our interim dividend to 15p. Our outlook remains positive, supported by broad-based US industrial growth drivers, and we now expect operating profit to be modestly ahead of the current market consensus for the full year, reflecting continuing good momentum following the earnings upgrade in May. We expect profit to be slightly H1 weighted due to the phasing of orders in engineered solutions and anticipated FX headwinds in the second half. In summary, a very strong set of results. I will now pass over to Hannah to go through the financial performance in more detail.
Good morning, everyone. The group has delivered a record set of results for the first half. Revenue was 420.8 million, 9% ahead of 2022 on an organic constant currency basis. And at 62.5 million, underlying operating profit OCC growth was an impressive 20%. Acquisitions contributed 41 million of revenue and 8 million of operating profit in the period. Operating margin increased to 14.9%, a 240 basis point improvement compared to the same period last year. The strong margin expansion is attributable to an improved portfolio mix driven by engineered solutions and the benefits of operational gearing. Underlying profit before tax was 42% higher at 57.2 million, and with an effective tax rate of 25%, earnings per share for continuing operations increased by 39% to 53.6 pence. We're also pleased to report that earnings per share for the total group increased by 24%, driven by the strong underlying performance of the business and the redeployment of the France Galva proceeds into acquisitions with higher growth and higher quality earnings. So turning to the group overview, the results reflect the strong momentum in the US and a resilient performance in the UK. As the charts at the top illustrate, the US continues to grow in relative importance and generated 56% of revenue and 73% of operating profit in the period, highlighting the higher margin performance of our US businesses, supported by their good market positions and structural growth drivers. In terms of the weighting between divisions, the Engineered Solutions division delivered an exceptional first half performance, generating 50% of group profit, driven by buoyant demand for composite solutions and electricity substation components in the US. The Galvanizing Services division represented 36% of group profits, with a record performance in the US and a resilient performance in our UK business. While the Roads and Security division delivered good constant currency growth, it continues to underperform compared to the other divisions, and margins were impacted by restructuring costs in our US roads business. If we now turn to our divisional performance, starting with Engineered Solutions. The division delivered a standout performance in the first half, with 17% revenue growth and 89% profit growth on an OCC basis. Operating margin increased by 670 basis points to 17%, reflecting the benefits of operational gearing and the quality of our faster-growing US portfolio. As reflected on the top right chart, the US delivered 27% OCC revenue growth and record operating profit. Our US composite business delivered an excellent performance, underpinned by high demand for its range of composite solutions. The business delivered improved margins compared to H1 2022, a soft comparator, due to a more favourable product mix and increased volumes. Given the high level of composite project activity in H1, we expect full-year profit to be first half weighted. We were delighted to welcome Enduro Composites to the group in February, and trading since acquisition has been ahead of expectations. Our electricity substation business also delivered record profit in the period and enters the second half with a strong order book, supported by demand to expand and upgrade ageing electricity infrastructure. Overall prospects for future growth in all our US engineered solutions businesses are very positive. We expect market demand to be supported by investment to modernise the electric grid and multi-year planned government spending on infrastructure, in addition to private investment to onshore vital components and processes. In the UK, revenue fell by 4% on an organic basis, but profit was at similar levels to H1 2022. The industrial flooring business delivered a resilient performance with buoyant demand from markets including data centre, battery plants and oil and gas. As expected, volumes in our UK-based building product business were lower than the same period last year, reflecting a slowdown in new build and repair and maintenance sectors. As a result, the 2023 outlook for the UK is more mixed than in the US. So turning to galvanizing. The Galvanizing Services division delivered a robust performance in the period, with 10% organic revenue growth and operating profit at similar levels to H1 2022, a strong comparator. The division continued to deliver superior margins with operating margin of 22.7%, reflecting the value-added service provided to our customers. As shown in the top right chart, the US business delivered a strong performance with 18% OCC revenue growth and record operating profit. The strong growth is due to buoyant demand with a 15% organic increase in production volumes. The integration of Korn's Galvanizing, acquired in March, is going well. The outlook for the US remains positive, with the business well placed to benefit from high levels of industrial activity supported by the IIJA, technology investment, and onshoring, and Alan will cover this in more detail later. In the UK, revenue was flat on an organic basis, reflecting a 19% decline in volumes, offset by pricing actions taken to cover higher labour and energy costs. The volume decline reflects challenges of the wider end markets, with certain key customers delaying projects. As a result, operating profit was lower than last year's record first half. Our market-leading UK business benefits from a good sectoral spread of customers, and while we expect certain end markets to be challenging, the business is focusing on more resilient growth sectors and is cautiously positive for the second half. Turning to roads and security, the division delivered 7% revenue growth and 15% profit growth on a constant currency basis, with strong trading in National Signal, our recently acquired US off-grid solar lighting business. Operating profit was lower on an OCC basis, given restructuring costs in our US roads business and a more challenging UK economic backdrop. As a result, first half operating margin only showed a modest improvement compared to H1 2022, and we expect further margin improvement in the second half. As indicated in the top right chart, UK roads revenue was 5% lower and operating profit was also lower than H1 2022 on an organic basis. While the barrier rental business delivered an improved performance with an increased level of fleet utilisation, our wider UK roads portfolio experienced challenges with inflationary and budgetary pressures resulting in project delays and cancellations. We expect the UK outlook to continue to be challenging into 2024 and that project activity may slow down next year in anticipation of Road Investment Strategy 3. In the US, trading in National Signal was very strong, supported by a high order backlog and buoyant demand from rental companies. While we do not expect to see such exceptional levels of demand in the second half, the medium-term outlook for the business is positive, underpinned by a drive towards sustainable off-grid solar solutions and an expected boom in large-scale infrastructure projects. OCC revenue growth in our US roads business was 2%. However, operating profit was significantly impacted by restructuring costs, mainly associated with re-engineering the trailer product line. The new senior management team are implementing a range of operational improvement plans, and we expect the business to make some progress in the second half. The medium-term outlook for the business remains positive, with demand supported by increased levels of state and federal investment to upgrade US road infrastructure. Our UK security businesses delivered a resilient performance, and while the outlook remains mixed, we expect our quality product offering and a focus on more resilient end markets such as data centres will support further progress. So moving on to cash generation and financing. We are pleased to report that the group delivered strong cash conversion in the first half at 87%, a significant improvement compared to the same period last year. The improvement reflects a tight focus on working capital and an easing of supply chain challenges, which has enabled certain businesses to reduce their stock holding. We expect the group to deliver cash conversion in line or above our target level of 80% plus for the full year. The working capital outflow in the period was 7.2 million, and capital expenditure was 12.3 million, representing a multiple of depreciation and amortization of 1.2 times. Cash tax paid in the period was 14.9 million, the increase reflecting higher profitability and our decision to carry forward taxable UK losses to be used in future periods. As a result, the group generated 34.8 million of free cash flow in the period, providing funds to support our acquisition strategy and dividend policy. And in the first half, we allocated 38 million of capital across two value-enhancing acquisitions, Enduro Composites and Corns Galvanizing. We continue to maintain significant liquidity headroom and leverage capacity to support future growth opportunities. Net debt at the end of the period was 132.1 million, with the ratio of covenant net debt to EBITDA remaining at 0.7 times. Return on invested capital in the first half was 21.3%, the improvement reflecting the strong trading and our disciplined approach to capital investment. So now turning to our ESG focus areas. Sustainability is a structural growth driver for our business. Our products and services make infrastructure more sustainable and increase transport safety. Our ESG strategy encompasses 7 focus areas, including our commitment to reduce greenhouse gas emissions. During the period, we successfully completed an extensive exercise to establish the group baseline data for all emission scopes, and this has enabled us to submit both near and long-term SBTi commitments for approval, with an overarching target to reach net zero GHG emissions across the value chain by 2050. And this sits alongside our commitment to reach net zero for our scope 1 and 2 emissions by 2040. As a reminder, in March this year, we set out an updated financial framework for the group, against which we will judge our performance through the cycle. The framework is a translation of the capability and the potential of the business that we have today, with a higher quality, higher growth portfolio supported by long-term structural growth drivers. As part of this, we set a metric of delivering 15% operating margin over the medium term. In the first half, the group delivered operating margin of 14.9%, which reflects the strong margin progression in engineered solutions, and in particular, the strong start to the year in US composites. The quality of the engineered solutions portfolio that we have today provides us with confidence that the division is capable of achieving 15% plus margins on a consistent basis, which in turn will underpin the overall group metric. The other area to highlight is cash conversion. The achievement of 87% cash conversion in the first half puts the group well on track to delivering our goal of 80% plus cash conversion, consistent with historic trends. I will now pass over to Alan.
Great, thank you, Hannah. I now want to focus on 3 key areas: the US industrial market backdrop, performance of our most recent acquisitions, and recap on our investment case. We continue to see strong market demand in the US, we see three specific growth drivers: onshoring, technology, and federal funding in the form of the IIJA. Each is having a positive impact on our businesses. What we show on this slide is a diagram of where we are seeing the focus of certain areas of onshoring and technology spend. As you will see, there is a very strong overlap with our core locations in the Northeast, Midwest, and Southeast. In respect of the IIJA, we are showing on the right-hand side of this slide announced spend to date. This is very consistent with what we said in March, that we are starting to see the benefit of spend in roads and bridges, but will only see the benefit of large-scale public transportation, airport and waterway projects through 2024 and onwards. It is this combination of growth drivers which contribute to our medium and long-term confidence. Turning to M&A, we completed 4 acquisitions over the last 9 months, recycling the proceeds from France Galva. What I wanted to do here is give a brief update on each of these acquisitions. National Signal is our California-based solar lighting business. This market remains strong, and we have seen excellent margin progression from 12% when we acquired the business to north of 15%. The 180-day integration plan is fully complete. We have also appointed a full-time CFO into the business. Over the next 12 months, we will be looking to move out of our existing 53,000 square foot facility to support future growth. Enduro is our Houston-based acquisition, which sits under Creative Composites Group. The rationale for the acquisition was to provide us with greater access into the Gulf Coast region, add new applications, and provide additional well-invested capacity. The 180-day plan is largely completed, and we have again seen margins move up from 10% to north of 15%, as we see the benefits of synergies across Composites Group. We've committed to a new $2.2 million pultrusion line to go in by the end of 2023, which will add significant new capacity to serve our utility customers. Corns Galvanizing has been fully integrated into our US galvanizing business, V&S, and a new management team put in place on day one. Trading is in line with expectations. We're in the process of automating the spin line, which will ensure we're able to move margins up in line with our US average. In the UK, Widnes Galvanizing has been similarly fully integrated into our Joseph Ash business, with a new leadership team in place at the site. Trading is ahead of our expectations, and we've seen the benefits from improvement in health and safety, as well as enhanced operating efficiencies. Overall, we're delighted with the progress with each of these acquisitions. Before leaving M&A, I wanted to use the growth of our composites business as an example of how the group has been able to use M&A to successfully enter a new market. The origin of our investment in composites was in the acquisition of Creative Pultrusion in 2009. Between 2016 and 18, we then made 4 bolt-on acquisitions, helping to broaden our capabilities outside of pultrusion. This year, we made our largest acquisition, Enduro Composites, giving a pro forma 2022 composites revenue of $150 million. We've been able to more than double operating margins since date of acquisition on the 4 of those first acquisitions. Creative Composites Group today is a recognized US market leader and innovator in the application of composite materials. We will be hosting a seminar in late November to give you more information on this exciting market. Turning now to a reminder of our investment case. It is built upon 6 key pillars. It is about exposure to the growth in infrastructure spend through businesses which are market leaders in the niche markets they serve, and where sustainability is critical to both the products we manufacture and the way we operate. It is then about maintaining an entrepreneurial, agile business culture. We're able to use our strong balance sheet and high cash conversion to invest in both organic and inorganic growth opportunities and drive margin expansion. And it is doing all of this in a consistent and highly replicable way in order to drive shareholder value. Finally, turning to outlook. Short term, while we expect to see some FX headwinds in H2, we remain confident about our full year outlook being modestly ahead of current analyst consensus. We also go into H2 with a good M&A pipeline, particularly in the US. Medium and longer term, we expect to continue to benefit from high levels of infrastructure spend, particularly in the US, but also in the UK. Well, thank you very much, everyone.